Robinhood stock, HOOD, Hood, is getting a lot of investor interest because they've grown so quickly over the last few quarters, hundreds of percent, on their mission to democratize access to investing. So, do they truly follow that name, the Robinhood name, steal from the rich to give to the poor? Or are they actually a platform that effectively steals from the poor that gives to the rich? I'd love to hear your thoughts in the comments below. I'm going to talk later on throughout this video, not only on their growth, but also why I'm very skeptical of their business model, skeptical of effectively the Robinhood promise, in that in reality, I personally think it is more along the lines of stealing from the poor to give to the rich. I'll talk about the valuation at the end of this video, how honestly it's just too hard for me despite the fact that they've had such hyper growth in the last few quarters and past years. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. I'm looking for potential multi-baggers, folks. I'm looking for companies that could potentially go up hundreds or even thousands of percent over time. So should Robinhood be part of your investment journey? Personally, too hard for me. But if it's part of your investment journey, please leave a note in the comments below. So let's dive into understanding Hood, Robinhood stock. And so understanding Robinhood, it's investing for everyone, commission-free investing. That's the main appeal for a lot of folks, saying, hey, I don't have to pay anything to invest. I just have to buy the stocks that I want. I just have to put up some of the money to do it. Isn't that awesome? You know, you get all the tools. You can sign up for a newsletter. You can get a debit card. So this is all about democratizing investing. And honestly, they have been pioneering the user experience to make it easier to sign up, to get access to cool things like IPOs, and a lot of Robinhood users are getting access to the Robinhood IPO, or fractional shares where you can invest in thousands of stocks with as little as $1. Or hey, this is what they used to do, where hey, you just made a purchase for Groupon or you just deposited 10 bucks, you get confetti, whoopee! And they subsequently removed that feature, recognizing that, you know, it's kind of gamifying investing a little too much. You might be attracting or encouraging the wrong type of habits. Let's just trade as much as possible versus the long-term mindset that investors would benefit from. And that's the whole purpose of this channel. I'm trying to take a long-term mindset to investing versus sort of the speculative mindset that I think a lot of Robinhood investors are considering. And I'll get more into that in just a second. Now, Robinhood has posted incredible account growth, growing from just a few thousand back in 2013 to literally 18 million in the first quarter of 2021. You can see a lot of their growth happened in 2020 in response to COVID. Maybe folks got their stimulus checks. And so accounts went from 5 million to 12.5 million in 2020. And then they exploded further to 18 million in the first quarter of 2021. And that is just parabolic growth when you think about it. Seeing, holy smokes, from 5 to 12.5, and then another 50% growth in just one quarter, going to 18 million. And so that is getting a lot of investors excited. And that's part of the reason why they're going public right now. Keep in mind, investors need to understand there's a dance that goes off when you go public, because when you are going public, usually you want to time it when you're putting up amazing numbers. You don't generally see companies go public when they're just doing terribly. That's because they can't do it. No one would want to buy it. So they try to time it saying, hey, we are putting up a monster quarter. Let's try to value this business off of the quarter where we grew 50%. It's hard to beat that, and we're probably not going to in the future. And so one needs to always, with all IPOs, sort of take a pause and say, well, wait a second, what do I think will be that growth rate in the quarters ahead, in the years ahead? Because ultimately that growth rate, let's say in year 2, 3, 4, 5 from now, is really what drives your return in terms of that multiple, in terms of where that multiple goes. That said, over time, the vast majority of returns are driven by fundamentals. And so that's another key component that we'll talk about later on in this video. So now let's go back to understanding the parabolic growth with Robinhood, where not only have they had parabolic growth, they've had parabolic business or fundamental expansion, as their revenue has gone from nearly 50 million in 2017 to nearly $1 billion, 20x growth in 2020. So that is incredible. And now they've gone to significant profitability, 155 million in EBITDA. Now that might be adjusted for stock-based compensation, so their true profitability is probably a lot lower. But now let's understand this business in greater detail to understand, okay, well, wait a second, what's driving this $1 billion in revenue in 2020? And so when you want to understand what's going on, about 80% of their revenue is transaction based, and that's how they describe it. Total transaction based revenue, about 81% in the first quarter of 2021, of which 38% was options, 17% were cryptocurrencies. And so these, I generally view options as a zero-sum game. I'm much less attracted to options versus stocks. But, a lot of folks are looking to make a quick buck. A lot of folks are looking to do speculative activities with cryptocurrencies. So that's what I think you're seeing here. This is not about long-term investing. This is about short-term trading, leveraging the dollars, the account that you have with, let's say, YOLO options. That's the go. You only live once options. And that's what you see here with, 50, 60% of their business in options and cryptocurrencies. And then the other 20% of their business that is not transaction-based revenue is largely tied to interest income, which, you can think is primarily tied to securities lending securities for short sales, as well as margin lending. So that's really the crux of the business as it is. They have talked about the Robinhood Gold platform, which, gives you access to margin and research, which costs something like $5 to $10 a month. That really isn't driving their business at this point when you understand their actual financials. That said, you do need to peel back the layers a little bit when you see, 80% in revenue, that's transaction based, but transaction based is really payment for order flow. And this is where it gets a little tricky. I'm not going to do a full deep dive on this. I can leave a link below to understand this in greater detail. But what happens with payment for order flow is you have clients send their buy and sell orders to a broker. In this case, it's Robinhood. Then Robinhood then transmits that order to a high frequency trading fund or market maker. And there are a few major firms like Citadel or Virtu that are the key players here. So the broker sends the orders to this market maker. The market maker then decides what's the right price for buying said stock or selling said stock, and then passes it back on. So, okay, you made this trade. Now we're passing the security or we're transacting back to the broker. Broker then relays back to the client, hey, you bought, you sold this. Now, the way this works is that the Citadel, the market maker, Virtu, the high frequency trading firm, they pay Robinhood for sending the orders to them. And that in and of itself should strike you as like, wait a second, isn't that sort of weird? And if you look at major big banks, if you were to look at like a Goldman Sachs, for example, and you were to say, hey, I want to place my order with you, Goldman. And what would happen is Goldman would then take their order from their brokerage and then would send it to their trading desk. And then boom, they would do it. They'd make it happen. And then you'd find out, your transaction went through. Versus what you have here where you're effectively splitting up, okay, there's the broker and then there's the one that's effectively doing the order, the market maker or the high frequency trading firm. And this does create a bit of conflict, in my opinion, because the broker really is getting paid from these market makers to send the orders. And part of the reason why the market makers are paying them so much is because they aren't necessarily executing their orders on the main exchange. They might be doing it through something like a dark pool where they can get a larger bid-ask spread and make even more money. So it does start getting tricky here. I'm going to leave a link below if you want to learn more about how payment for order flow is a very conflicted model in my mind. But if you ever wonder how come Robinhood is able to advertise their products and services for free effectively, it's because of this convoluted model of payment for order flow, where the broker, which is Robinhood, is sending their orders to set market makers. Market makers are making a nice spread, and then they're transacting, passing the securities back along to the broker who sends it back to the client. So that's what you see here. And here it is, Robinhood, 80% of their revenue is effectively kickbacks from the market makers saying, oh, thanks for sending the orders our way. Now, if you were to think about this for a second, if they're effectively paying them, oh, thanks for sending the business, our way terms of the market making activity, you know what? That means they're probably making a ton of money off of that. This isn't going to be a tiny spread. So I would think, whatever dollar figure you're looking at here, it might be double what it is because it's going to be super, high margins for these types of business. And you can confirm that by looking at publicly traded Virtu as well. This is, your gross margins could be quite high for this market maker, high frequency trading firm. And so here's the part where I start struggling with it and I start going down to the idea of like, okay, this strikes me as the idea of Robinhood stealing from the poor to give to the rich. And let's break that down a bit, where in the first quarter, they had first quarter 2021, they had about 18 million funded accounts versus assets under custody of around 81 billion. So that implies the average account value is around $4,500, $4,500 for the average account. So this is not big accounts. Like most brokerage accounts, like you're talking about Main Street brokerage firms, you're talking about hundreds of thousands of dollars potentially. Like Interactive Brokers, I believe, is around $250,000, and that's the brokerage that I personally use. And so this is a teeny tiny fraction of what a lot of the other brokerages are looking at. And the amount of revenue that these accounts generate is around $137 per year. Now we know that of that $137, about 80% is from payment to order flow. So that means about $110 is payment for order flow for these accounts that are on average $4,500. So that means the fees that these users don't recognize that they're paying because it's quote unquote free is really about 2.5% of the account value. So yeah, sure, it's free, but it's effectively enticing users to products that are effectively paying Robinhood between 2 to 3% of their account per year. And keep in mind, it's even more when you consider the fact that the market makers are really making a ton. So the market makers might have a 50% gross margin, maybe more, in which case this really means these accounts are effectively indirectly paying 5 to 6% to Wall Street. So this, in my mind, you have the smallest accounts, the $4,500 accounts on average, paying these high frequency trading firms, these market makers, on average about 5 to 6% of their accounts per year. And if you were to compare this to these major, brokerage accounts that have more, straightforward fee structures, it is, fractions of what you're looking at. And that's part of the reason why I prefer to use Interactive Brokers, where it's very straightforward. They have the option, hey, if you want a free, we can do that, but the trading isn't going to be as good. You're going to be indirectly paying for it with your execution of your trades. Or you can pay up and you know what you pay for. You're getting a very affordable commission. It's very straightforward. And the reality is, relative to the account value that you're paying, which is, effectively 5-6%, 2.5% going directly to Robinhood, quote unquote free. If you were to compare it to something like Interactive Brokers, it's literally, 1/100th the amount, or, between 1/100th and 1/10th the amount that you'd look at in terms of thinking of that friction cost that Wall Street's charging. Okay, so what are my thoughts on valuation as we look at Robinhood? Clearly I'm not super enticed by the business model. And so here it is. I'm going to do a quick plug, if you will. Or if this is your first time tuning in, you're watching Unrivaled Investing. My name is Daniel. Please make a point of hitting that subscribe button, hitting that thumbs up if you enjoy learning about stocks, learning about potential multi-baggers. If you want to follow my personal journey as I try to find potential multi-baggers, stocks could potentially go up hundreds or thousands of percent over time. Go to unrivaledinvesting.com. First week of the month, I call it my full portfolio. Once a month, I call it a potential multi-bagger. And I have weekly email updates that go straight to your inbox. So that's at unrivaledinvesting.com. Let's continue to understand the valuation for Robinhood. And so as I look at the valuation for Robinhood, first, in order to continue their hyper growth, one should understand sort of the ceilings, or at least the limits that they might be reaching, where in the United States, and which is where they predominantly operate right now, as in terms of the most recent registration statement, they said they operated solely in the United States. There's only about 210 million adults in the United States, And they have about, at the end of the second quarter 2021, they have about 21 million active users. So that implies that they have about, Robinhood has about 10% of US adults. And it's probably greater as the percentage of adults that have investment accounts. So in order to justify, like, well, how much can this really grow, given that they already have all these sorts of competitors? I would argue they've found a niche in democratizing finance for folks that previously didn't even find it to be accessible. And what bothers me is that folks are enticed to think that it's free, where in reality, Robinhood, through this payment for order flow model, is effectively charging users, somewhere between 2 to 6% a year, and also encouraging users to trade in products that cost a lot. If you were to buy stocks, it's probably not going to be as much, but trading in options where your spreads are much wider, that's also a key component. And so in order to justify continued hyper growth, they are clearly going to need to expand into international, and that is on their radar, but that will be tougher because there are already existing players out there that have already seen this happen. That said, they could definitely do it. Just recognizing, like, wait a second, how much potential really is there in the United States at this point? Another key element to think about in terms of understanding their valuation is like, okay, so where are they at today? And one should understand this business has decelerated significantly. So in fiscal 2020, they did around $1 billion in revenue. In the first quarter, they did about $522 million in revenue. And then that growth rate slowed significantly. Because keep in mind, this is a 50% delta between the full year 2020 and the first quarter. That growth rate slowed significantly to, they're estimating, somewhere between 546 and 574 million in the second quarter. So maybe you're talking about, $2 billion in revenue. Maybe, they're saying their EBITDA figure is somewhere between 59 million and 103 million. Maybe that implies an annualized EBITDA of around 400 million. These are ballpark hypothetical figures. Things can be way worse than this, maybe even better. And so based on, let's say, EBITDA of 400 million, a complete guesstimate would be around 300 million adjusted income. That's a very, very rough ballpark figure. And then you consider, wait a second, they're expected to get valued around $32 billion with this IPO. So effectively 100 times optimized earnings for this company. And keep in mind, this business is tied to human nature. It's tied to how much do people want to trade in options? How much do people want to trade in cryptocurrencies? How many new users do they grow? Yes, let's imagine they keep growing the users. But if users all of a sudden say, I don't feel like trading as much. I didn't get a stimulus this month. I don't have the money to trade, or I'm no longer interested in the game. And that's honestly what I expect is going to happen to a lot of folks. I think after you get the hurrah, this is amazing, stocks only, go up attitude, slowly fade out, people will start to say, like, wait a second, like, I don't even want to check my account statement. I don't even want to log in. And when that happens, when people are just like, ugh, I don't want to think about how much money I lost in this. Like, when that happens, then trading activity will decline significantly. When trading activity declines significantly, then the Citadels of the world, these high-frequency trading firms, these market makers, they're going to say, well, wait a second, you're not sending us the orders, so we're not going to be sending you money. We're not sending effectively these rebates back. So, yeah, this business has grown a lot, but no one says that this grows straight to heaven. It's very possible for this business to decline. It's very possible that in 5 years from now, this business is at the same or lower revenue. And that's why this is really hard to value, in my opinion, as I look at Robinhood. Sure, there's a lot of aspects democratizing finance, but I look at this and this is really capitalizing on the recent speculative juices that you're seeing with option trading and cryptocurrency. Case in point, 6% of their first quarter 2021 revenue was in Dogecoin. And that is a cryptocurrency that was made as a joke. Literally, the founders talk about it was made as a joke. So here it is. I'm looking at this, and that is the ultimate sign of speculative froth. That revenue could be zero. A lot of their cryptocurrency trading could be a lot lower. Their option trading could be a lot lower in the future. This is just too hard for me. This goes in the too hard pile, as I think, like, wait a second. Is it really possible you keep putting up this growth? What if the business gets regulated in the future where, effectively Congress says, wait a second, this payment for order flow is hyper conflicted in terms of you sending these orders here, they execute it, let's say in off of the exchange at their own, potentially wider spreads, and that's the reason why they're able to do all of this. And that's how you're able to get these trades for free. And this whole model can get disrupted. 80% of their revenue can dramatically get legislated away. It just strikes me as too hard. There are plenty of other companies that strike me as much better risk reward. At unraveledinvesting.com each month, I call out potential multi-baggers. An example is a healthcare play I called out in July, growing at 70 to 80%, trading at 3 to 4 times sales. And that's an example of like, okay, profitable business, hyper growth, reasonable valuation. That does strike me as asymmetric risk reward, and that's what I'm looking for. Whereas looking at something like Robinhood, where it's like, okay, 100 times optimized, optimized earnings figure may or may not be the same size in 5 years from now. Like, it is not a definitely will be bigger 5 years from now. And that's sort of like a key filter I think about with every company that I'm looking at, is like, how much conviction do I have that this business could be so much bigger 5 years from now? And as I look at this with Robinhood, I'm like, wait a second, speculative juices can get reined in significantly. Wait until you see when Jerome Powell says, you know what, we're actually raising rates, or we're not going to continue, we're tapering QE. At that point, and after market sells off, at that point, do you really still have this sort of speculative juices going on with joke cryptocurrencies or option trading? We'll see. I'm very skeptical of this setup. It's a hard pass for me. It's definitely a warning for all those investors out there, because it wouldn't surprise me if this business, if they don't post significant growth and they just stay where they are, let's say over this next year, you could have a dramatic re-rating of their valuation from, let's say, this optimized earnings multiple of 100 times. You could have 20 times. You can have just a huge fall in valuation. That's how I see it. Unless they're able to massively execute on their growth, it's just too hard pile for me. If you feel like Robinhood should be part of your journey and I'm clearly missing something, leave it in the comments below. I try to be open-minded here, have an open mind, listen to thoughts, listen to, conflicting arguments. Leave a comment below. If this video was helpful for you learning about Robinhood, please make a point of subscribing and hit that thumbs up button. Thanks so much for watching.